discovery. Okay. And it's joined to work with Rize Jha, who's a graduate student at Columbia, and Xia Huyu, who is a postdoc. And that's really a market microstructure study of decentralized exchange, not really of decentralized exchange, but more of how price discovery arises in decentralized exchange, and what is the relation between decentralized and centralized exchange in this process. So any feedback is very welcome. This is still work in progress. We are trying to get feedback and fully improve the paper. And I think this is a great audience because there are many experts here in market microstructure. Let me go ahead and start with like what I'm going to say. First, I want to briefly introduce the area because some of you might have already heard about DeFi, decentralized exchange. Some others may not have had the opportunity to learn about it yet. But I think there is an interesting analogy that one can draw between centralized and decentralized exchange, which I want to present. Then I want to discuss the data. This is pretty much an empirical study. It's not a theoretical analysis. Discuss the empirical methodologies and then derive some results that relate to price discovery. So the first point I want to make is, can I move the bar? Okay, good. No. Yeah, good. Hide video. Yeah, so I want to start with an introduction to centralized exchange. I mean, I think many of us have already seen how they work. Like, for example, if we think about the New York Stock Exchange, what they do is they typically run a centralized limit order book where all market makers submit their orders. All traders who want to consume liquidity, they also submit their market orders. Typically, the liquidity provision is done through limit orders submitted by market makers. And the objective here is to compete on speed, in the sense that if you have some information and you want to trade on it, or if you want to execute quickly, then you should basically collocate your servers close to the exchange so that you get the order on the exchange quickly and before others. So clearly there is a competition on latency. And in fact, there has been an enormous amount of literature start looking at exactly how latency plays a role in these high frequency trading markets. Now, when we think about decentralized exchange, there is somewhat different mechanisms to decide what determines the priority of an order. Decentralized exchange, which are typically abbreviated with DEXs, which stands for decentralized exchange, typically they don't use a centralized limit order book. So there is not a single repository where all the orders are placed, but they use the so-called automated market maker, and they execute this order in batches. So the idea is that the orders that you submit are not immediately or instantaneously executed, but every roughly 12 seconds. This is the case for the Ethereum blockchain. So this exchange operates on a blockchain, which is a distributed ledger where many transactions are submitted, and then the validators will pick this transaction and will execute them. For example, you submit an order to exchange one asset for the other, then every 12 seconds, all these orders will be seen and processed by a validator who gets the right to update the ledger, and they will be appended in the chain in decreasing order of fees. So if you want to prioritize the execution of your order, you have to bribe the validators. You have to submit a higher fee because this will give you higher priority. So it's not really speed, but it's fee which determines the execution priority. Yeah, Kostas?
Is there any room for front running within mempool? Let's say if somebody wants to trade, I don't know, 1,000 Ethereum on the decentralized exchange, which will probably move price on decentralized exchange in a certain way. If I see that someone is submitting such a large thing to a mempool, can I attach another transaction to front run them and this higher fee?
Yeah, that's a great question. Like because all these transactions are submitted to this memory pool of the validator, so they are stored in this memory pool temporarily before they get executed. Then, as Costa said, if I observe that somebody submit an order, large order, then what I can do is I can front run him. I can submit the same order with a higher fee so that I get prioritized in execution, and I would execute at the price that Costas would have got. So there is, and in fact, I think we have another paper which is exactly looking at that, like front running and back running. Like you can be sandwiched by an attacker by first loads on his position by and this happens within the mempool. So I see you executing, so I submit the same order, selling like even more shares than what you're doing with a higher fee. I get executed at a favorable price because I'm paying the price that you should have paid. The price goes up, you get executed later, so you have to pay a larger price, and then I can sell and back run you. So that's the idea. And this is actually one of the main problems for these blockchains, because there is this transparent observability of transactions, which is problematic. What we are arguing in this paper is that like this transparency might actually be also beneficial for price discovery.
So why don't we use like batch auctions and get around this problem of prioritization and results in better price discovery?
Batch auction.
Stopping other exchanges, or how did Mempool come up with this system?
Yeah, no, that's a good question. So somewhat the auction is in a way a batch auction in the sense that you are not continuously executing transactions, but you are executing this transaction only every 12 seconds or so, based on the fees that are bid. Now, in order to prevent this problem of being front running, instead of batch auction, another potential solution that has been proposed is to use some private pool like that in a way similar to the dark pools, where you submit your transactions directly to the validators, and the validators will be able to basically execute your orders without anybody else seeing your order. So you submit your transactions to me, and in principle, I'm not allowed to front run you because of the rule of the protocol. So you will be protected against these front running attacks. Yeah.
I have a couple questions real quick. The fees, is it like I know it's not dollars, was it like a dollar amount fee or a percentage? Meaning if you are having a large transaction, you get a relatively smaller fee, or?
That's a good question. These are absolute fees. These are like paid in the Ethereum currency. So you submit a fee, which is like G weighs the unit.
So
which
is fair to say that larger transactions are more likely to take priority because they can afford the larger fee?
It's not completely clear yet. It's not clear that if you have a larger if you want to submit a larger transaction, then you would be the higher fee. It really depends on how urgent or how, for example, if you have private information and you want to exploit it, even if it's not a large transaction, you are still willing to be the higher fee. Of course, you will still make an argument and say, okay, am I paying a larger fee than the value that I would get from executing this transaction?
Yeah, like a million Ethereum could pay 1,000 Ethereum fee better than a $1,000 transaction.
Yeah, usually you would expect that this is the case. Like if you are like gaining more because you are placing a larger order, then you are also willing to be the higher fee. But if you are not in a hurry to execute this large order, you can also submit a lower fee. So how urgent it is for you to trade is what is really determining the size of the fee.
Okay, and if I ask us one more question,
yeah, sure.
We have the fee component, but when you're talking about the price that if I didn't trade but I'm observing the price, is the price I observe the price plus the fee altogether?
Yeah, yeah. You observe everything. You observe the price at which you get executed and the fee that is being paid for the execution. This is all transparently observable.
Okay, but if I just look up a price quote, the quote I'm looking at has the price and the fee.
No, it only has the price.
Oh, okay.
Yeah, the fees, they are two distinct characteristics. So the price is, for example, you look at the exchange, the domain market maker is setting a price. Then if you want to prioritize your execution, you have to pay the fee. But these fees are related to the price.
Okay.
I have this question. I think Dr. Sakho touched on that. There's a mining extraction value.
Miner extractable value.
Where we index is trading as opposed to centralized exchange trading. How how do we know that the higher blockchain is not due to this mining extraction fees? Then the opposite just getting by the traders.
Yeah, no, that's a good question. So the miner extractable value, that's like related to the front running paper that I was mentioning before. This is basically related to the fact that in the end, when there is competition of fees, because everybody wants to prioritize its execution. For example, if we both want to front run a transaction, we want to front run Costas and We both try to bid higher fee so that we can exploit this opportunity. Ultimately, who is gaining this fee? The validators, because these are the ones who will be basically getting the fee when they append the transactions in the block. And this is referred to as money extractable value. So it's really like the fee that is being earned by the validators, because by competition, we are squeezing out each other, right? We are not really getting much because we both compete up to the point where we would be completely flat. So that's like, I mean, the money extractable values mean one reason why this fee could be high is because of these front running transactions. In this paper, we're not really looking at why they are high. We're more looking at whether or not you can extract some information from high fees. Good.
One more thing, like,
Yeah.
but I just want to understand, like, since you look at central exchange, also there are aggregators, right? Like, in theory, theoretically, can you get a better price in aggregators than DEXs? But
Prices, usually there are like, if you want to get good prices in DEXs, you could look at different automated market makers. Each one is offering a different price, and typically you want to trade in a pool which is deep and where maybe there is not a large price impact coming from the complexity of the automated market making function. That's typically what you do when you want to get a good execution. Yeah, I think this is anticipated a little bit. Some of the questions like this, on the left, I want to really draw the analogy between automated market maker and centralized limit order book. For automated for centralized limit order book, how do you provide liquidity? Market makers or HFT submit limit orders. They rest in the book, and then if you want to consume liquidity, you submit, let's say, market order or another limit order, and they will be crossed, and you will execute either at the best ask or at the best bid, depending on whether you want to buy or sell, and then you walk through the book. If you think about instead trading in an automated market maker, that's a very different process, because instead of limit orders, every provider of liquidity could be anybody, could be me, you, like Costas, PK, anybody can provide liquidity. This positions will basically, this pair of tokens will be deposited in a big pool. So this pool is a shared resource where all the tokens are deposited. And then what happens is that if I want to trade, I want, for example, to swap some token A for token B, then I deposit token A in the pool. So the quantity of token A in the pool will increase, and I take out token B. So the number of token B in the pool will decrease. And this convexity is measuring the price impact. The fact that when you trade, you impose a pressure on the prices. So you are not getting, let's say, 5 token A for 5 token B, even if at this point we have 5 token A and 5 token B, you deposit maybe 5 token A and you get out 3 token B, which is exactly measured the cost of your execution. But this pricing function is determined, you can see it's coded by an algorithm, which is called a smart contract. So it's a very different way. So in other words, one way to say is that here you have a more active, in a centralized meter book, market making is more active, like you have a more active form of active process. Instead here, market making is more passive. You have to trade in order to update the price. There is the only way to update prices, which means how much is one token A worth in terms of token B, is to trade. So it's not that market makers update quote, which is instead what you can do in a centralized limit order book. Yeah.
What I understand, what market makers can also do, they can basically put in both tokens and move this whole curve a little bit outward, and they get a fee from the exchange.
You mean they could deposit, the liquidity provider could deposit more tokens?
Yeah, they can just deposit. Yeah, they can deposit more tokens.
Yeah.
And this whole curve will shift a little bit.
Yeah, you will shift you can shift the curve up. Yeah, that's possible. That's a good
how
point.
you make the market more liquid, and you get fees from the exchange.
You know me, if you deposit, you get fee from the traders, from those who will trade. Because every time I want to execute a trade, for example, if I want to swap token A for token B, I have to pay a trading fee, which is different from the priority fee that I mentioned before. And this trading fee will go to the liquidity providers. Yes. So that's the fee that you mentioned. Yeah. No, it's a good point. So it can also be implemented in the way you said. You deposit more tokens, you make the pool deeper, and you will Yeah, question.
Yeah, I'm not sure if I'm missing something. This sounds like the Kyle market maker setup. Is it, or is there a big difference that I'm missing?
The Kyle market maker setup, like, okay, one point here is that there is not
It's a different pricing function, but
different pricing function. Also, there is no, this pricing function is visible to everybody, so there is no asymmetric information in this model, or in general in the market maker, because we see exactly the quantities that are in the pool, the token A and token B. We see the
for the trade, it's not known. I think it says auction. There's a many auction, and there's no balance that comes out of that.
Even before trading, you know exactly what is the size of the pool. So this is visible at any point in time. You always know that. So I think a big difference with respect to the Kyle's model is that really the market makers are not really updating the quotes directly, like it's more like they're depositing tokens, and then you trade, and by trading you update the prices. Yeah.
Can, when it's in the mempool, can they be canceled? I mean, can traders essentially spoof the mempool?
That's a good question. So how do you implement cancellation in this exchange? You cannot really do the cancellation in the same way that you would do in the centralized mutual book. But what you do is typically every time you transact, each transaction has a nonce. And the rule is that you have to execute, the nonce is basically counting the number of transactions submitted by the same trader. So now if a trader realizes that like he wants to cancel the transaction, then what he does, what he would do is he would submit a revised order, which has the same nonce, a higher fee, and then in this revised order, he would say transfer, for example, 0 Ethereum dollar to my account. So then the validator will decide to pick. I mean, when the validator has to decide which order to pick, they will pick the order which has the same fee. So the transaction, they will look at the transaction nonce, and they will pick exactly the one with the higher fee, which is transfer $0 to myself, which means nothing. And therefore, the old transaction, which has the same nonce, will be discarded because you can only execute one transaction with the same nonce. Does it make sense?
But you have to pay a fee to cancel?
Yeah, you have to pay a higher fee so that you can prioritize that order and not the previous order that you submitted. Yeah, you have to pay somewhat different. It can be infinitesimal. You don't have to increase the fee too much. You just increase it a bit so that the validator will pick this new transaction nonce, which is essentially implementing a cancellation, because once that nonce order has been executed, all the other transactions with the same nonce will be discarded.
Yeah, maybe not very clear. I guess what I'm asking is, you said on Ethereum it batch orders every 12 seconds.
Yeah.
So if I'm a validator,
Yeah.
can I guess what I'm asking is, can the validator act as a trader and spoof it with a bunch of orders with artificially high fees and then cancel it before the 12 seconds goes up in an effort to induce other traders to bid against me and then end up with higher fees?
I see what you mean.
Can that happen? Because that seems like it would directly relate to your reason.
Yeah. In principle, it could, like there is nothing preventing the validator from doing that. I don't know how much of spoofing in that sense there is, but it would be considered legal in this market to do that. Now, I don't know if the validators are engaging this type of behavior that you're saying, like incentivize it, more orders to be the higher fee, but
It would seem like that would be likely to happen at times of high congestion, which is when there'd be high fees, which is when there'd be price impact. So
yeah.
Good.
Yeah, it's a good question. I mean, I've not looked at it, but that
Traders and validators may be one and the same.
yeah, so they could be different, but they could be the same. Sorry. Yeah. So a validator could be a trader as well. There is no. Yeah. Okay, so now just want to make the point that if we look at the ratio of volume traded on decentralized versus centralized exchanges, it's still small, like in the sense that the vast majority of trades happen on the centralized exchanges. But as we have seen, like starting from the middle of 2020, the volume on the centralized exchange has reached about 15 to 20% the volume of centralized exchange. So centralized exchange here, I mean the crypto exchange, the crypto centralized exchange, for example, Binance, right? That's the largest one. But the centralized exchange, like one has to pay attention because they're increasing in volume and they are definitely becoming comparable, at least in the sense of the order of magnitude, to the volume that you see on Binance and on the largest centralized exchanges. Yeah.
Yes. I'm suggesting that maybe this number is more of a lower bound on this on the decentralized exchange volume, because the volume of decentralized exchange is observable to everyone. It's very difficult to fake it, while volume on centralized exchange can be really, it's in their inner wallet. It can be anything that they reported, and it doesn't have to be.
You're right.
Maybe
You mean
a much higher proportion of actual trades, not fake trades.
on the decentralized exchange. Yeah, that's a good point. Yeah, because you have exactly the transaction on the. It's easy to trade because you just look at the blockchain, Ethereum blockchain pretty much, and a few other blockchains which are supporting this decentralized exchange. But for centralized exchange, like you have to rely on whatever Binance is reporting. Yeah. Good. So let me go to the main question that we are trying to answer in this paper. The main question is really about price discovery. So how does price discovery happen on the centralized exchange? What type of information can we extract from the fees that are paid to get priority execution? So this, I think, is really a new signal that you have on the centralized exchange, which is absent in centralized exchange, because, as I mentioned before, you don't really have fees to determine the priority of your orders. And then we want to understand if there is some economic channel that we can use in order to explain the results. Okay, so let me go to the literature. I think the most related to literature to this study is really the information content of trades. I think there has been some old studies in the market microstructure literature which looks at block trades versus non-block trades, with the idea is that if you have more information, then you are submitting, larger trades, larger block trades, and these are more privately informed. And then later on, see a paper by the same authors, at least O'Hara, Yao, and Ye, basically reverse the results, because they said, okay, now that we have HFTs, the HFTs are trying to hide their information, and therefore they split their orders into smaller orders to hide their information. So they found that like round lot trades, which are trades, smaller trades with compared to odd lot trades, which are like trades in 100 shares, have more information than larger order trades. There has been also some other study about the choice of the venue versus electronic communication network versus the Nasdaq exchange in terms of where you direct your orders, depending on the information that you have. Here, we are looking really at the private information content, but not really focusing on the size of the order, but more on the information that we can get from the fees. In fact, as we will show, the size is not the only trading signal. Like even if you control for size, you still see that the fees are conveying information for trading. And there is also an emerging stream of literature on decentralized exchange, including another paper that I've written on this topic. But over there, like the focus is more on like what type of incentives to provide liquidity can be provided to market makers, depending on the fees that is charged when it's traded. Okay, so let me discuss the data. We look at the sample period between November 18, 2020 and February 10, 2021. So the cutoff dates are basically chosen to avoid the period before November 18 was essentially the period where Uniswap, which is the largest decentralized exchange, was holding like a staking for their tokens. And therefore, we wanted to avoid like any structural breaks that comes because of the termination of the staking program, which happened to be exactly on November 18, 2020. And after February 20, 2021, the flash bots, which are essentially these private pools where you can submit transactions directly to validators to eliminate front running, were created. So that's why we don't want to include also this period in the data set.
Is there any way to observe whether this front running is really eliminated? Because even if mempool is not like publicly public, there can be an infinite amount of those validators who will see it and trade it, in the direction of the trade that they are validating?
Yeah, no, that's a good question. And I mean, in the other paper, we actually show that front running is not eliminated with these private pools. The reason being that if I'm a validator, I don't have an incentive to go on these private pools, because if we all do that, then there will not be front running. So I'm not getting any fees from the competition between the arbitrageurs. I only go to this front running, to these private pools, if the front running cost is not too large, so that those victims will still submit transactions to the public pools. Like, but if they are only using the private pool, if they are only using the private pool because they're worried that they have been front run, then I want to capture this transaction, so we will all go to the private pool. But if it's not the case, then I still want to monitor the public pool because I want to profit of the money extracted to buy. Yeah, good question. I should have also presented that paper. No, it's good. Yeah.
Traders avoid front running just to submit their orders at the very last millisecond before auction closes?
Okay, that's a good question. If you want to reduce the risk of being front run, you could try to time the time when the submission of your order exactly to 1 millisecond before the validators will append the block. This is definitely doable or can be done right now because blocks are executed every 12 seconds. But this change has been implemented by Ethereum, like this deterministic validation of the block every 12 seconds has been implemented only since last November, when they moved to proof of stake from proof of work. Before, the validation of the block was done on average every 20 seconds or so, but it was not deterministic, it was a random variable, so you didn't know exactly when the order was being mined. But now that the blocks are validated every 12 seconds, in principle, one could look at whether there is any timing that is being made. And this is an interesting thing. We were thinking about a project along those directions. And so as I mentioned, we have both stable, we look at both stable pairs and non-stable pairs. So stable pairs means pairs of stable coins. So you swap one stable coin for another stable coin in the exchange. And we look at the three main stable coins in terms of volume traded, which are USDC, USDT, and DAI. So USDC is the stable coin issued by Circle. USDT is the stable coin issued by Tether, which is another company. And DAI is the stable coin, the decentralized stable coin issued by MakerDAO. And then we also look at non-stable pairs, which mean pairs of tokens for which at least one of the token is not a stable coin. For example, Ethereum versus USDT. Ethereum is not a stable coin. Like stable coin means pegged to the US dollar. So that's what stable means, that really the value is the equivalent of $1 US. Then we look at the wrapped Bitcoin versus Ethereum. So these are two no stable coins. So this is really a very unstable pair. Then we have Link, which is the chain link coin. Aave, which is the coin of the Aave lending protocol, decentralized lending protocol. So these are all stable, unstable pairs. And we have both data from trades which have been executed and data from trades which are pending in the main pool, in the public main pool of a validator. So for executed trade data, which we can observe both on Binance and on Uniswap, Binance is the largest centralized exchange, Uniswap is the largest decentralized exchange. We observe the timestamp of the trade, so when it has been submitted, the execution price, at what price the trade has been executed, and what's the size of the trade. But if we, in addition, if we look at decentralized exchanges, Uniswap is the one that we're using, we also see the hash number of the transaction. We see the block number, so in which block this transaction has been included, which is the address of the trader who submitted the transaction, what is his nonce, like the transaction nonce, like every transaction is counting the number of transactions submitted by the same trader address, and also what is the priority fee, which is characterized by the gas price and the gas used. So this is essentially, the gas is really capturing how much computational power you need in order to execute this transaction. And for the decentralized trades, we also observe other information coming from the fact that these orders are pending in the memory pool of a validator before being executed. In fact, we see again the hash number timestamp, the address of the trader, and the gas price and the gas used. So basically, using this information, we can match exactly the pending orders to the executed trade data. So we can see, for example, if an order has been revised in terms of the fee before being executed, because you can match the executed trades data with the mempool data, which is really nice because you can really observe what is the history of this order. So now, for the methodology that we are using to estimate or to measure the price discovery, following like a classical paper by Hasbrook, which basically developed a structural VR model to measure the information content of a trade. We are using this for DEX trades. So the structural VR model proposed by Hasbrook is basically a vector autoregressive model where there is contemporaneous correlation between the endogenous variables. And A is capturing this contemporaneous correlation, the matrix A. We have a lag that we use in order to regress the variables on the their previous values. In the analysis, we are choosing the lag to be equal to 5, but we have experimented also with different lag, and the results are not changing dramatically. And then we have the structural innovation terms, which are zero mean and uncorrelated with each other. So that's like really a textbook now type of methodology. So the question is, how do we implement this methodology? What is the variable, the vector of endogenous variables? We look at both centralized exchange and decentralized exchange data. For centralized exchange, we look at the return on Binance. For decentralized exchange, we look at the trade flows, and we decompose this trade flow in terms of low fee, mid fee, and high fee. So the idea is that we want to see exactly whether high fee trade flows will have an impact on the return on the centralized exchange. How we compute this trading flow? We basically look at the single, for each block, we aggregate all the trade flows which have high fees, and we also account for the directionality of the order. If it's a buy or a sell order, we compute the net order flow for those orders which have high fees. Then we do the same for those orders which have low fee, and then we do the same for this order which have medium fee. So I is basically the fee indicator of which group we are considering. Yeah, that's not.
Why do you use return on centralized exchanges here instead of the actual return on decentralized?
Because I want, that's a good question. The reason is that I want to see, like, if market makers update their quotes after they observe a trade on the centralized exchange. This is essentially showing me that price discovery is happening on the decentralized exchange. So if I see that the market maker is revising its quote in response to a large order, which had high, in response to an order with a high fee on the decentralized exchange, that's likely as an indication that this order contains private information because it has led the market maker to revise their quote.
And these low fee, mid fee, and high fee, these are mempool variables or trade variables or actual trade variables.
These are executed trade data.
But if it's executed traded, then essentially you can pretty much predict the price on the centralized exchange from them. Can you?
So how can you predict the price? Because you see.
Yeah, you see the volume, and it should be deterministic on it should deterministically predict the return on the decentralized exchange.
You mean from the volume on the from the traded volume on the decentralized exchange, you could use them to predict the prices.
The change in price on this.
Yeah, you can see how the curve on the automated market maker looks like.
Yeah,
but
so this leads to the question. Let's say, why can't you just merge these three variables into actual return on decentralized exchange and run Hasbrook 1995 instead of Hasbrook 1991? The essentially what you are doing here is that you are splitting the return on decentralized exchange into three subgroups, which is very interesting on its own.
Yeah.
But you are still pretty much deterministically predict price changes through these all three components.
Yeah.
And then what I think it means is that this low fee, mid fee volume is just well, coming at different times, and if there's higher congestion or lower congestion. So
Yeah.
essentially what you can do is either merge them together or extract price changes from these volumes.
Mhm.
Price changes on the decentralized exchanges, and then do this vector error correction model as in Hasbro 1995, and tell which exact part of the order flow is contributing most highest information share, similar to Hasbro 1991, but it just I think it will. I think it will just be a more conventional way of doing it.
I see.
If your readers understand how volume can deterministically affect prices and
Yeah. No, it's a good suggestion. I didn't think about that. So you're saying let's first develop a model to predict prices on or
just take it from
to take see
automated market maker.
yeah to the main and then you would still account for this high fee, low fee,
Yes,
mid fee decomposition.
Sure.
But now it's in terms of the returns on the decentralized exchange instead of the
Yeah,
trade flows.
exactly.
Yeah, I will think about that. It's a good point.
It would be more understandable for an average or market microstructure person, as long as you explain that it's pretty much the same thing, the return and volume traded.
Yeah, no, I agree, because the timing is still like you still look at the flows and returns can be essentially mapped one instantaneously at the time where no, it's not, but at the same time where the block is validated. Good.
So it's Augustine, maybe I'm gonna get to this, but on the previous slide, you had matrix A.
Yeah.
Right, and it's a structural
Yeah.
matrix. But in the paper, you actually write that out. I don't know if you're going to get to that here.
Yeah.
But the zero restrictions are identifying the
A.
model.
Yeah.
You know, when I looked at it, I didn't understand. I don't know enough to know why there are zero restrictions in particular equations.
Yeah.
Maybe you could explain that a little better, either in the paper or in 2 sentences. What confused me a little bit, it looked like we were forcing auto-regressive. You're making the system recursive by the A matrix.
Yeah.
But then later you impose restrictions and it's identified. Then you later impose restrictions on the variance covariance matrix when you estimate the impulse response.
Yeah.
But those are redundant. If this A matrix is carried through to the estimation.
I see.
And so I don't know. So it's over-identified, then over-identified again. So the first set of over-identification restrictions make the vector non-unique.
Yeah.
And then imposing the restrictions in the variance covariance matrix is not necessary. But when you do it, I don't know how that affects the empirical results.
Yeah.
I'm way ahead of where you are, but
Yeah, no, I see what you mean.
the A matrix.
Yeah, no, I think I agree that there is a constraint on the covariance imposed after, and I would look at exactly what I see your point. I'm doing a bit more about it. So the idea is basically to set up this metric in a way that the causality is from the order flows to the returns. So we want to make sure that we want to capture exactly how trading in the decentralized exchange is impacting the quotes on the centralized exchange.
Costia's comments are embedded in that A matrix.
Yeah.
Right. And you're kind of assuming that structure.
Yeah, you mean this structure, this directionality of the rate, exactly. I mean, we tested also for the reverse. Sorry, what if like after a trade on the centralized exchange, so after observing a return on the or a change in price on the centralized exchange, there is a trading, for example, due to hedging reasons, you go and try to trade on the centralized exchange, And then you see that somewhat the results remain similar in the sense that the price discovery and information share is still there, but is less pronounced. So we check both for one direction and the other, just to make sure that the results are robust with respect to how you specify the A matrix.
It's all testable.
Yeah, no, but it's good. I think we
It's
should
empirical.
explain more the paper. Because
Since we started talking about AIM-based,
Yeah.
I also worked through it, and in 191, their assumption is that trades move prices, and
Yeah.
that's why
Yeah.
contemporaneous trades move prices. But
yeah.
I think in your metrics, it's in metrics, it's much more complicated. So there are prices, and then low fee contemporaneous trades move prices, but medium fee are driven by low fees contemporaneous, and high fees are driven by
Low fee
fees,
and mid fee
medium fees, and
Yeah.
I understand how you can
And,
code it into VR model, but I think it would help the readers to understand why you make this assumption that they have this specific chain reaction to these contemporaneous correlations.
Yeah, one reason why we chose this order, like the low fee are causing mid fee, and low fee and mid fee are causing high fee, is to get somewhat a lower bound on the price cover. If you do the opposite, like high fee are causing low fee and mid fee are causing low fee, then you basically would.
But what if they don't cause each other?
You mean if they are not in a relation with each other? Yeah.
They contemporaneously cause returns, but
Yeah.
I don't.
I see, but-
Unless there is some explanation to this.
I see what you mean.
It just it probably overcomplicates it.
Yeah, no, I agree. That's I mean, this is we didn't test this. I mean, we conjectured that. We said, okay, if this is the case, we would get an upper bound in the result. If you do the opposite, you get a lower bound. If they are uncorrelated with each other, it's probably in between the two cases where it was one directionally or the other. I think if I think back to your previous comment, if you look at the returns, you still have this problem, right? That you have to impose a relation between the.
Yeah.
So one is to think about how to get around this problem in general.
So before, for the benefit of the time series, metric students, before we jump to a VC, you should test for the ordered integration. So this have to be I0 for the structural VAR. And I1 for the VC. Again, that's kind of pre-analysis. That needs to be done with data. And it's an empirical question.
Check for the order of integration. Yeah, exactly. We'll do that.
I assume they're all I0 since you're doing it as structure.
Yeah, no, exactly. But we should do that.
That's just the fun.
Okay.
So have you included all possible variables in the model? Because I'm thinking more about equity markets. There's commissions, then there's spreads, there's payment for order flows. All of these, in fact, commissions have now become zero. So is this even sustainable to attack the fee? The model should include all of the sources of revenues. And even maybe price impact, right? So then maybe optimize. That may be a pretty good innovation, because this is starting from scratch in a way. It's a new exchange. And they can optimize during because in the equity market, it's not very transparent. How exactly are brokers making money? I don't know if it is in this market.
Yeah, no, here we have included we have included also other variables in the robustness analysis, but pretty much we included flows on the centralized exchanges in addition to the flow on the decentralized exchanges, but we didn't account for commission fee or trading fees. So on. The reason is that we wanted really to look at how trading flows are predicting prices. How trading flow on decentralized exchange are predicting price on centralized exchanges. But we could do that. We could see what happens if you control for other variables as well.
Yeah, the beauty of this model is there's a whole vector of unknown. Exogenous variables as well. They could be added in for specific.
Exactly.
So you've opened up. At least 10 more papers.
Hopefully, exactly. No, but these are good points. Like, indeed, they could be included. Right. So as I was mentioning, we construct those flows, mid fee, high fee, high fee. Okay, this is this is like the baseline. As I mentioned before, we're assuming that DEX trade flows are contemporaneously affecting the return on the centralized exchange, but not vice versa. And we have flipped this assumption in some robustness checks that we have done, where we do the opposite, that now centralized exchanges are causing the trading flows on the decentralized exchange. And as I mentioned before, the results are not qualitatively changing, so we still observe similar patterns. And if there is time, I would go over the robustness checks. Otherwise, we can discuss also offline.
Typically, it should be the other way around. The central discovers prices, or is it? Like in dark pools, they're all derivatively priced.
Yeah.
The main lit central exchange is where the price is coming down, because buyers and sellers are coming together.
Yeah. No, yeah, could be the, we didn't really test whether or not it's one or the other. The idea why we're looking at from trading flows to centralized exchange is exactly to understand whether there is price discovery on the decentralized exchange, because if the market maker are trading their quotes on a centralized exchange, it means that they have observed the trading flow there. So, but it could be the other way. I agree with you, and it's not clear what they do. That's why we looked at the reverse assumption. We cannot do both simultaneously, because otherwise the method would break. But
what you could do here is just write out an A matrix with all of the coefficients in the model.
Yeah.
Identify it through the variance covariance matrix, and then test the significance of each coefficient. As a pre-analysis, and then if they're not statistically significant, that would justify the zeros.
I see. So you're right.
The strategy for explaining this.
Yeah. So I think write an A matrix and then try to estimate it and see how significant they are the coefficients, so that you could make a claim for one or the other.
Yeah, and you can identify the model with restrictions on the variance covariance matrix. And that'll enable you to solve the impulse response functions and the variance shares, even with a full A matrix.
Yeah.
But it's not likely to be. But then you go back and make these assumptions based on your pre-analysis.
Yeah, no, that's a good question.
I mean, the theory should tell you.
Yeah. Which direction it takes. Good. Yeah.
This is a great paper, by the way, for time series.
After all these changes that I have left to make based on your points. Yeah.
So I think in your example, just compare just one centralized exchange.
But yeah, exactly.
There are several centralized exchanges and decentralized exchanges. So do you consider to look at this kind of external validity test to compare while using the same model, but you choose the trade price or any variables from those different centralized exchanges as well as decentralized?
Yeah, no, we didn't do that.
There are a lot of them.
There are, in principle, this is doable, although like there is a big difference between, let's say, the largest and the second largest. Like if you look at Binance, it's the largest centralized exchange. There used to be FTX before it blew up. But now if you look at the third largest centralized exchange, it's like 1/10 or even smaller than Binance. So in principle, like being most really of the liquidity is concentrated on those like
but
centralized.
But that depends on which cryptos you are trading. I think it's like if I trade USD versus Bitcoin, and pretty much they do have a lot of trading volumes in the first and second, the Coinbase and
Coinbase. I think it's true. If maybe one could, if I look at specific pairs, there could be that Coinbase, for example, for stable pairs might be somewhat more comparable to Uniswap.
So my suggestion is you look at least one of them.
Yeah, no, it's a good suggestion. In principle, we have the data, so we could do that. So to decide like how to construct these blocks, or to construct these groups, low fee, mid fee, high fee, what we do is we take the last 20 non-empty blocks that we see on Ethereum, and then we rank order the trades in decreasing order of fees from the largest to the smallest, and then we compute the quantile of this distribution, and we say all the trades which are in the top quartile, which means on the 75% quantile or above, they will be classified as high fee price trades. All the ones that are in the bottom quartile, they will be classified as low fee price trades. And then we have the one in the middle, which we quantify as mid fee DEX trades. And really, we are really interested in low fee and high fee, but because we wanted to have some margin of difference with low fee and mid fee, if we did 50% and 50%, then a low fee trade, which is in the 49% quantile of distribution, could be close to a 51% trade, which is in the upper quintile of the distribution, and then we would have classified them differently. But here, I think the separation between low fee and mid fee is more pronounced because we have this intermediate group. One important point that I want to make is also that the time convention here is important because, again, order flows on Binance, they are observed continuously on time, so the time is running continuously, but on Ethereum, on the decentralized exchange, the time is discrete because an order is constructed or is appended to the chain every 12 seconds. So then we have to decide, okay, when we do this vector structural VAR, how do we define the time? And the time is the block time. So when we compute the return on the centralized exchange, the return is computed as the price when the last block has been validated, which is 12 seconds ago, minus the price when the new block is being constructed, which is now divided by the price at the time where the last block was constructed. Right? So the return is not really the instantaneous return, but is the return with a time horizon of 12 seconds. Yeah.
Just a question about the ordering. So if a block is being formed, orders come into that, then people can observe that and go to trade on the centralized exchange.
Yeah.
It seems like you're placing it. Are you placing the incoming order at the time it gets validated?
Yeah,
It looks like you might be giving credit for that information from that order to the centralized, even though it was first revealed and decentralized. Am I right?
Right. So let me be more precise. So basically, I first construct this block using the history of the past trades, and then I look at the current trades and I decide in which block to assign them. Right.
Okay.
So I basically compute the distribution of what mean the boundary between low fee, mid fee, and high fee using the past 20 blocks. Now I look at the present block and I decide where to assign these rates. So then the permanent price impact is defined to be the cumulative impulse response of the return on the centralized exchange to a unit shock of the variable. So that's like the way the aggregate price impact, which basically takes into account all the future responses of the return on the centralized exchange to a shock, for example, to a trading flows that they would apply today. And these shocks are like applying standard deviation, like of the trading flows.
So these are one standard deviation.
One standard deviation shocks, exactly. Good. And then the information share is defined to be exactly as Asbrook in his 1991 paper defined. It says the square of the permanent price impact times the variance of the structural innovation term normalized properly so that it sums up to 1. So now let me meet. I think the first question is who would be the high fee, right? And the question is it arbitrageurs who are exploiting private information? For example, if I observe that there is a price misalignment between a centralized and decentralized exchange, I may want to exploit it by trading both on the centralized exchange and the decentralized exchange so that I can close out this arbitrage opportunity. And if I want to win the race for exploiting these arbitrage opportunities, I might be willing to bid a high fee. So in principle, they could do that. Or is it privately informed traders, like traders who have short-lived information and they want to exploit it, so they want to bid a high fee to reduce execution risk. So they want to get on the block, right? Execution risk means that you don't want to wait long because the information is short-lived. So if you don't exploit it, it may no longer be useful. But there is a caveat to that, because if you bid a high fee, then you are somewhat revealing information. So you are exposed to backrunners who can trade together with you and exploit this information. So if you bid a high fee, you are basically signaling that you have some information, and therefore you are exposed to others who can backrun you, precisely because this fee is being posted on the public mempool, so it's visible to everybody. And it's not clear a priori whether or not these high fee trades are driven by public or private information. So is it one, the other, it's both? That's what we want to look at. Yeah, question.
Yeah, I have a couple of questions, but let me start with this. Who pays the fee? Is it the party that is selling the coin, or that is buying the coin? And who determines that?
You mean the priority, this fee that I'm mentioning here, right? The fee is paid by the trader, the arbitrager who wants to execute its order.
So if there's a difference in prices and I want to I want to buy it on the centralized exchange, and it's cheaper than on the centralized.
Yeah, you would.
Am I bidding the fee?
Yeah.
I'm saying I'm willing to.
Yeah, exactly. You would bid the fee. For example, you observe that there has been a price shock on Bitcoin on the centralized exchange. So buying Bitcoin on the centralized exchange is more expensive. You want to sell on the centralized exchange. So you would buy Bitcoin on the decentralized exchange, and you want to do it quickly. So you are willing to bid a very high fee, so that the validator will pick your order, will execute it, and then you can get your Bitcoin from the decentralized exchange and sell them on Binance for an Ethereum. So you have to pay the fee.
I'm unclear how it works, because if I want to buy it, I'm willing to bid a high fee, and there's some other trader who wants to sell it.
Yeah.
And is also willing to
Bid a high fee. Yeah.
The validator is getting two fees at once, or?
Yeah, no, okay. What happened is that after this 12 seconds, well, the last block was validated 12 seconds ago. Now 12 seconds have passed. I am the validator who gets the right to update the chain. I will look at all transactions that have been submitted in the last 12 seconds. And I will say, let me prioritize them in decreasing order of fees. So even if there are two high fees, presumably one fee will be higher than another, right? So I will take the transaction with the highest fee and I will execute it first, and then I will go down.
But the transaction coming into the validator, the buyer and the seller are already matched up when it gets to the validator. Is that correct? There is no
real matching going on. You submit your transaction and you are interacting with the automated market maker. So you say, I want to buy 5 Bitcoins for 2 Ethereum. I submit another transaction. I want to sell 6 Ethereum for 2 Bitcoin. So I'm submitting this transaction, and my counterparty, my intermediary, is the automated market maker, is the algorithm that will look at the liquidity in the pool and will execute the order. So you don't have to be matched. I'm not selling. You are not really matched with the buyer. You are matched with the market maker. So your counterparty is the automated market maker, is this algorithm.
So this is, and I should have asked this earlier, this is, these are investors that are buying and that are trading coins like securities, not using them like currency to transact.
Yeah,
they sell things.
The reason why they are trading is unclear. I mean, they could be trading because they want to exploit opportunities. They might want to get access to a security, like for example, an Ethereum token, because they want to run a DApp on the Ethereum blockchain. And for this DApp, you need Ethereum token. Or you might want to swap an NFT token because you want to claim some NFT collectibles. Like the reason of trading is not clear, but you just want to get access to this token.
That makes some information. Can I ask one more question?
Yeah, absolutely.
When we're talking about information leakage, and this isn't, I haven't looked at the cryptocurrency literature for a few years, so I'm not going to be updated here. But typically, when we talk about information, we're talking about information on future cash flows and the applicable discount rate.
Yeah.
Which isn't that a central problem to cryptocurrencies? I mean, there aren't cash flows associated with it. And so we're talking about information. I mean, what kind of private information can you have if there's not, am I mistaken, is there not well established valuation?
Here, when I think about, when I think about private information, I mean, it could be the way that we process information, me and you, is different. For example, we all observe, if we think about tokens, which are not stable coins, like these tokens do not have firms which report balance sheet, for example. So really, it's up to you to decide whether or not one token is being overvalued or undervalued. And maybe you have an expertise on, I mean, you know very well how Ethereum token fluctuating prices. I might know how Bitcoin tokens fluctuating prices. So I might have more private information than you because I'm able to understand better or predict better what is the changing price. So this is really information that is the private information about token valuation, which is different, for example, from information about equity, because in that case, pretty much we can look at the balance sheet and we all have the same information. So we all come up with the same way of processing the information. It's not, I'm not thinking about like learning how to discount future cash flows.
Yeah, but I guess when we're talking about the information related to the value of to the price of
Of a token,
a coin,
yeah.
are we not really talking about, I mean, how do we know it's not all noise? I guess that's the central question I've had on cryptocurrency for a long time.
Yeah.
Is why is my information about Bitcoin being worth 22,000 more valuable than your information about Bitcoin thinks it's 16,000, other than it's just noise, and me willing to pay a higher fee might just be louder noise, not necessarily information, right? Like I might be willing to pay a higher fee because I want the immediacy, which has nothing to do with the value of the coin.
Yeah.
That's just straight noise. But the market might just say, oh, someone's willing to pay a high fee, so I guess it's just worth a lot. When it's
So the way I'm not really answering this question microscopically in terms of understanding the source information, but my point is that if you are if it's a liquidity trader, if you are, for example, you want to get you want to sell a large amount of those coins because of any reason, allocation reason, for example, then we wouldn't observe a permanent price impact, because the price allocation would be transient, and then the price would return back to the value that was before your execution, right? But then my point is that if instead we observe that there is a large impulse response for the future returns on the trade flows, that means that there must have been some information that has been incorporated into the price. And this must be private information.
okay.
That's but I'm not really disentangling, okay, what are the exact reasons, what are the exact sources of this private information? That's, I agree, it could be partly noise.
But the scenario you just
It could be wrong, exactly. I mean, I might have wrong private information.
The rest of the market just says, oh, there must be information there.
Yeah.
Right, in which case.
Yeah.
There's no information so much as it's just what's the loudest noise, which I think is has different implications for finance in general rather than specific here. So,
yeah, exactly. If the noise is leading to if it's noise, in principle, the price should not deviate, right? Over the longer term, you should go back to the previous value, right? That's the argument. So if it's noise, then it shouldn't really be, we shouldn't see a large value for the impulse response function. That's fine.
As I understand, I guess that there are actually the crypto fees come where you can see how much each blockchain is generating.
Yeah.
I think that's what I understood from his question. Like you can look at how much each blockchain is generating.
Yeah.
And also Ethereum blockchain, there are other apps that are built on top of it. And Uniswap is one of the most profitable.
Yeah.
And you can see it and you can evaluate in terms of cash flow, this kind of thing, but you can use that. That's what I think is asking that question.
You mean that there are other transactions which are not related, not necessarily related to the centralized exchanges?
Yeah, like you can see how much each blockchain is generating fees, how much fees each blockchain generating, and you can like evaluate in terms of the equities that we evaluate. Like you can use that one, and evaluate like whether Ethereum or other blockchain is overvalued or undervalued. That's
you can look at the congestion of the blockchain, and I mean, I think one of the challenges that we are trying to understand here is also are you bidding high fees because you're worried about congestion and therefore you may not get executed now, you have to wait longer? Or are you building very, very high fee because you want to compete with others that have private information?
I'll draw a quick parallel with the equity markets here.
Yeah.
Isn't there a lot of internalization and like Coinbase may have a lot of accounts, but they register the coins in their name. So does every transaction has to go on the blockchain, or can it be an internal transfer within Coinbase from one account to another? A lot of information may be happening there.
Yeah, you're right. You could implement it. So, if you want to make a transaction, for example, between one account and another, then you could also do it without a blockchain. It could be a centralized. You can use a centralized exchange.
What's the proportion of the
transactions that go on blockchain versus the one that are executed like without
right.
blockchain? That I don't know. Don't know exactly. But
equity market mostly on the internet, because you don't go to the company and say, okay, register the shares in my name.
Yeah.
It's always in the broker's name, they just transfer internally.
right. If you here you still need to set up an account. Let's say if me and you want to do a transaction directly, then we both have an account on Coinbase and we can do a transfer directly on Coinbase. They're saying I could do that instead of going on the decentralized exchange and getting my tokens.
Let's move on.
Yeah, good. Yeah, this is great.
Almost out of time.
So let me discuss the permanent price impact here of the DEX trade flows. This I think hopefully answers some of the questions, at least to some extent. First, we look at what is the aggregate price impact, which is this impulse response function that I've discussed before. If we look at stable pairs, we don't really see any aggregate price impact coming from shocks to the decentralized exchange flows. Like everything is close to zero. The reason being is that this really stable coins have neither private nor public information because they are pegged to the dollar. So there is really no information reservation that needs to be incorporated into the prices. What is interesting, or it is more interesting, really what happens to the non-stable pairs, the pairs of tokens which are not necessarily both linked to the USD dollar or pegged to the USD dollar. And there we can see that if we break down in terms of low fee, mid fee, and high fee, the aggregate price impact is at least 8 times as large as the price impact that we see for low fee trade flows. So the argument is that high fee DEX trade flows have a significantly larger price impact, both economically significant and also statistically significant, compared to the low fee DEX trade flows, which is essentially making the argument that our argument is that the price discovery on DEX is realizing through these high fee blockchain fees that are bid by the traders to exploit their private information. And then in response to that, the market makers on the centralized exchange will update their quotes. So that's like the argument that by comparing these three groups, we can argue that aggregate price impact is the largest on the DEX trade flows with high fees. Okay, so now the argument is that a trade flow can have a high permanent price impact. That's what we have seen in the previous slide. But the question is, does it contribute to price discovery? Because what could happen is that, okay, despite the fact that it has aggregate price impact, maybe there will be many other traders that will observe that and they will be worried of competing against me, because if I have private information, they say, okay, I should not trade with him because otherwise I will be exploited. So that basically should reduce the trading volume, and as a result, it should reduce the standard deviation in the structural innovation term of the Hasbro model. So what I'm saying is that if the aggregate price impact is high, it doesn't mean necessarily the information share is higher, because the information share is the product of the aggregate price impact square and the variance of the structural innovation. So we want to basically look at whether it's also true that there is higher information share for the high fee DEX trade flows compared to the others. And again, if we look at the table, first, the highest contribution to the information share comes from the centralized exchange return, in the sense that shock today to a centralized exchange return has the highest impact on the future returns on the centralized exchange, because there is always public information used that are exploited. But the question is really, okay, how about the contribution from the DEX trade flows? And here we see that the high fee DEX trade flow has significantly larger information share compared to the low fee mid DEX trade flows, which again captures the fact that there is more like price discovery, more contribution to price discovery coming from the high fee DEX trade flows compared to the others. And another question is how quickly does this price discovery occur, right? So the argument, if we look at the impulse response function, how quickly does the return on the centralized exchange respond to high fee DEX trade flows? Which means that market makers would updating their market price to the efficient price faster, right? Because if they react faster, if they update their price quotes in response to flow to trading on the centralized exchange, it means that the price discovery is happening quicker. Yeah.
Quick question. Can you go to the previous slide?
Yeah.
Do you think that if the shape of this automated market maker function would be different, the contribution to price discovery of centralized exchange could be different?
Yeah, that's definitely the shape of the automated market maker function contribute, because if you have, for example, a more convex shape, which means that the price impact is higher, then there may be less willingness to transact on the decentralized exchange. And as a result, there might be less price discovery happening.
Also, how much in total liquidity there is?
Also, exactly, or if the pool is deeper.
The deeper the pool, the smaller the price impact, but the more, well, the deeper it is, the more.
Yeah, the deeper it is and the more contribution to price discovery there should be. Exactly. Yeah, in principle, this could be also tested if one looks at if periods where the pool was deeper and periods where the pool was shallower, and see whether the contribution to price discovery is changing.
Yeah, you can even have an exogenous shock for that, because the depth of this pool depends on the fee that exchange is paying to contribute to this pool, and when the fee changes, the pool will change, and it will exogenously affect price discovery.
Yeah. So when you say the exogenous shock would be what, a fee change? If you change the trading fee.
Yeah, the exchange fee, not the priority
but
fee,
the trading fee.
but the fees that exchange is paying to contribute to this pool.
Yeah. Because then the liquidity providers, if the fee, for example, goes up, they will have more incentive to provide, and therefore they will be developed. Yeah, that's a good point. I like it. Yes, and here we see that. I mean, if we compare the impulse response function for the centralized exchange return to high fee DEX flow versus mid fee and low fee, you see that for the response to the high fee DEX trade flows as a sharper drop, right? It quickly, after like around two block times, the price may reverse to the value before the trade flow occurred.
I just have a question about time.
Yeah.
0, 1, and 2.
Yeah.
This is the time between trades.
Between blocks.
Between
blocks. Yeah.
But that can vary. Right? So it's not a uniform length of real time.
Actually, it's every 12 seconds. So every 12 seconds.
The 12.
Yeah.
So these are constant. End of 12 seconds trade.
Or let's be more precise. It's on average 12. It's not exactly 12. Because this analysis was conducted before the switch to proof of stake.
Okay.
But on average, it's 12. But it is a random variable. Yeah. Exactly. Here we basically what we say, okay, how quickly does the price goes back? How quickly the exchange return responds? And how quickly the price discovery happens? Because
that's that unit at about 12 seconds is constant, or is not changing over time.
No.
So that
No.
is,
There is exactly. Okay, just mention some robustness tests. Like I have some backup slides, but for the sake of time, I just want to mention that if we, this is a question that we discussed a lot. Like if we reverse the causality order, we let exchange return to affect the trade flows, but not vice versa. You see that it has the same higher contribution to price discovery coming from the DEX trade flows with high fee, and you still see that the aggregate price impact is the largest for the DEX trade flows with high fees, although the magnitude is a bit smaller. Okay, which is somewhat expected because you are not like allowing the DEX trade flows to contemporaneously affect the returns. one could also control for centralized exchange rate flow. So you let's say, okay, what happens if you also account for the fact that it's not only trading doesn't only happen in the centralized exchange, but also happen in centralized exchange. So if we add the centralized exchange trade flows in this vector, then we observe that the return on the centralized exchange are still responding to DEX trade flows, and the aggregate price impact for high fee DEX trade flow is still the largest, although the values will be different because now we are controlling for an additional variable. And the last robustness check that we did is controlling for trade size. You might say, okay, are you sure that it's the fee that is determining like the response of market makers? And market makers are responding to high fee DEX trade flows, or are they responding to large size trade flows? So what we did, we decomposed actually, let me go back just to this one. We basically we decomposed the trading flows into 6 groups. We have small size and low fee DEX trade flows, small size and medium fee DEX trade flows, small size and high fee DEX trade flows, large size and low fee DEX trade flows, large size and medium fee DEX trade flows, and large size and high fee DEX trade flows. So we have 6 groups where we are both looking at the fee and at the size of the order. And then what we see is that if we look at these 4 groups and you look at the table, we see that for high fee DEX trade flows, which are large sizes, you see that the contribution of the aggregate price, the cumulative impulse response, which is the aggregate price impact, is still the largest. So even within the high fee group, even if you look at the large size trade flows, they are still using the blockchain fee as a signal. It's not that it disappears because we have controls for the size. Yeah, can we go back to... Good. So the last part I want to discuss is about why they are bidding these high fees. And we have come up with 2 plausible possibilities. The first is that you want to avoid execution risk. So if you have short-lived information,
please complete this in the next 5 minutes.
Yeah, 5 minutes will be enough. Yeah, sorry for that. Yeah. So essentially, it could be execution risk in the sense that, as I think back to your question, like informed traders are not only competing with other traders on the DEX, but they are also competing with other users who are using blockchain for other activities. For example, running NFT auction, issuing like tokens and so on. So according to this argument, if I'm worried about execution risk, then I just want to bid a fee which is sufficiently high to get into the block. I don't care if I am at the top of the block or I'm at the bottom of the block. I just want to be in the block. So I can look at the medium fee, maybe adjust for the standard deviation and try to bid fee sufficiently high to be into the block. Or it could be that I'm competing against other informed traders. In this case, I really have to take into account that because the orders are pending in the main pool, they will be observed by other traders who are actively monitoring the main pool. And this high fee might lead to information leakage. For example, there could be backrunners or predators, right? They observe my order flow. They see that I'm submitting a high fee and say, okay, he must be informed, so let me try to backrun him. In this case, I want to bid a fee which is way higher than those of the other non-DEX transactions because I really care about getting first in the execution. I have to be at the top of the block because if a backrunner is executing before me, then I'm not getting a good execution. So the question is really, is it about execution risk? Is it about competition? Is it about both? And so on. So then we do an outlier detector approach to identify DEX trades which have excessively high fees. And this is a standard methodology to detect outliers. And in the end, we say, okay, is excessively high fee like due to the fact that they are competing on public information? For example, there might be a cross exchange arbitrage. I might observe a price difference between the price on Binance and the price on the decentralized exchange, and I may want to exploit it. This is public information arbitrage. Or I might have some allocation motifs. I have to liquidate a large position, and I'm a liquidity. I have to execute a liquidation trade. Now, we want to see whether like these competition trades are really combining public or private information. So what we did is we eliminated all the trades with excessively high fees from the analysis, where excessively high fee has been measured using the outlier detection approach that I've shown in the previous slide. And we have rerun the structural DAR. And now we see that the aggregate price impact for high fee dexterous flow has dropped from 8 to 5.36, which basically lends support to the hypothesis that these excessively accurate fees are not really trades done for public information arbitrage opportunities, because otherwise you would not observe any drop in the aggregate price impact, right? You only observe a drop in the aggregate price impact if there is private information in this trade. If it's only public information, then price would revert back, and therefore the coefficient should not change. So then the final question is basically, okay, now that we have established that like these traders are competing on private information, then question is, how are they competing? Are they competing the hypothesis that has been put forward in the literature is priority gas auctions. So the idea is that in the mempool, I can observe your fee, and then I can bid a bit higher than you, and then you observe that I'm bidding higher, so you increase your fee even more, and so on. And the question is this like bidding up the blockchain fee? Is this the dominant bidding strategy? And we have identified these trades which can result from priority gas auctions, because everything is publicly observable. You can see if, for example, a trade has been revised. You observe the nonce of the transaction, and you see if there has been a higher fee bid between the previous block and the current block. If there is a lot of revision of the order, that means that there is a sign that there is competition between different traders. And then we look at, we basically, according to the strategy of whether, this identification strategy for priority gas auction trades versus none, we have basically counted what's the fraction of trades between two consecutive blocks where there has been a priority gas auction versus the one where there has not been a priority gas auction. And we actually see that the fraction of trades which have excessively high fee, for which the competition is on the form of a priority gas option, is only really small, like between 3% and 70%. So that means that the vast majority of trades competition is not happening through a priority gas option. And so what is going on is that they are bidding according to a jump bidding strategy. So they have an high blockchain fee, they bid a very high fee just once to discourage others from doing the same. So it's like a signaling tool to communicate to other traders, look, don't try to compete with me because I really have to get executed, and I'm willing to bid so high that you will be discouraged for doing that. So that's typically the type of bidding strategy that we are observing. The type of competition strategy that we're observing, like jump bidding, just bid a very high fee at the very beginning so that nobody is going to compete. Everybody will be scared because like it means that I really have this need of competing, of executing. And in a way, this jump bidding, I think, is a unique feature of competition on DEXs that you cannot see on centralized limit order book, right? Because what is the counterpart on a centralized limit order book? How would you signal your intention or your willingness to trade? I mean, you could use a market orders to have a faster execution, but you cannot really signal that you have a high valuation for your trade. So in that I think is really one argument in favor of public observable transactions. We have seen that the design is bad because there is front running, there is, you can be exploited because every trade is visible before execution. But on the other hand, with this jump bidding, you could basically be able to signal your private valuation to others and therefore avoid to get competed away. Okay, so this brings me to the end. Like, again, the point of this paper was to analyze how price discovery can occur in the centralized exchanges. And the strategy that we've used is exactly to measure this information flow, this information content of transactions using the 1991 Asbrook's methodology. And main point that we see is that the price discovery is realizing because traders are bidding high blockchain fees to signal or to exploit their short-lived private information. And in response to that, market makers are updating their quotes on the centralized exchanges. And you can really see that from traders are bidding high fees, not only because they want to reduce execution risk, because they care about being executed in the block, but also because they are competing with each other. So they really want to get first execution. In fact, they are competing in a jump bidding way. So they are not really engaging in a priority gas auction, but really discouraging or signaling their high valuation to other traders so that they get executed quickly. Yeah. And that's the end. I realized that I went over time by a large margin. Sorry. Yeah,
So there is PhD student meeting and we have to.
thank you, Augusto.
Yeah.
Okay, thank you all.
Yes, now.
Yeah, no, exactly.
And typically, it's also organized as a lunch
Yeah.
or